You are welcome to my channel. Today we are going to have a look at the accounting books. In our definition of accounting, we said accounting is the act of recording business transactions and summarizing them into financial statements for decision making by the users. So when we say that it's the act of recording, that means the recording takes place in a certain books. Now, when we record the business transaction, it means we are recording them in the accounting books. And so when we talk about the accounting books, we have quite a number of accounting books, but we have the broad classes of accounting books. We have two classes, and the two classes here, we have the subsidiary books and also the principal books. So, when we talk about the subsidiary books, this is where we record transactions for the very first time. If something has happened for the first time, we are recording it for the very first time. It's the first time we are entering this transaction into our books. We record it under the subsidiary books. And then, after recording it in the subsidiary books, we shall transfer the transactions or that information to the principal books. Now, the difference between the subsidiary books and the principal books is that when it comes to the subsidiary books, these books do not follow the double entry rule or the double entry system. Now, the principal books, these are books when we are recording the transactions, we follow the double entry system. So it means that here we are only recording them without having a double entry system. Then for the principal books, we shall follow the double entry system. So sometimes the subsidiary books, they are called the books of prime entry. They are called books of original entry. So we are going to look at the examples of the subsidiary books here. Now, when it comes to the subsidiary books, we have examples like the sales day book. We have the purchases day book. We have the sales returns day book. We have the purchases returns day book. We also have the cash book, and we have the journal. So sometimes these books, they are called journals. In fact, these books here, they are called special journals. They are called special journals. So we are going to look at each of them here. The sales day book. Now, the sales day book, for example, the business might be operating on, for example, we give out credit sales. For example, we might say we need our stock to get done by this period. So how are we going to make our stock to be done within our stores? So we might give out credit sales. Now, when we sell goods on credit, we shall record them in the sales day book. Sometimes it's called the sales journal. So when we sell goods on credit, we shall record those goods or those transactions that we have done in the sales day book. Now, the same applies here. When we purchase goods on credit, we shall record them under the purchases day book. Now, when it comes to the sales returns day book, now here, it's like we have sold our goods. Now, out of those goods, a certain number or certain amount of goods is returned to us. For example, we sell out goods worth 10,000. Now, from this 10,000, the person who has taken our goods actually realizes that like maybe around 2,000 of those goods are supposed to be returned. They are not maybe by standard, or they are not to the extent or the expectation that that person wanted. So he's going to return these goods. Now remember, these goods were taken on credit. So if they were taken on credit, that means we are going to come back and record them in the sales returns daybook. Now, the 2000 here will actually go in the sales returns daybook. So that's how we record our sales returns daybook. Now, we have the purchase sales returns daybook. This one applies the same way. When we are returning goods to the suppliers, as we, for example, we have got transactions, or we have got items. We have got items from a supplier and realize that these items still, maybe they are faulty, maybe they have a damage somewhere, so we return them to the supplier. Remember, we got these goods on credit. Now, if we got them on credit and we are taking them back to the supplier, we shall record them under the purchases returns daybook. Now, we have the cash book. Just like I told you here we are recording credit transactions. You know, we talked about the types of transactions and we said we have the credit transactions and the cash transactions. So cash transactions, these are transactions with payment is made on spot. You buy something and you pay either by check or by cash, depending on what mode of payment you are free with. Then when it comes to the cash book, remember these 4 record credit transactions. Now, when they go to the cash book only records cash transactions. It only records cash transactions. It records payments and receipts of cash. So that means here we only find transactions of cash only. Now, when we come to the general journal, all the other transactions that should be recorded for the first time and they don't fall in any of these, they will be found in the general journal. So that's how it is about the subsidiary books, and we shall look at an example of each and we shall solve a number on that. We are done looking at the subsidiary books. Now, I would like us to take a look at the principal books. We said, remember, principal books, these are books that follow the double entry system. They are books that follow the double entry rule. So it means after recording our books or our transactions in the subsidiary books, we shall transfer them to the principal books. Now, basically here we have 2 examples of principal books. We have one, a ledger, and the cash book. So the question is, how come we saw the cash book under the subsidiary books and we are seeing it under the principal books? Now, this is it. The cash book, remember, it records cash transactions for the first time. But also the cash book here, it follows the double entry system. So when we are entering into the cash book, we have that debit and credit. For example, when we are entering a transaction, we are going to follow the double entry system. So no other than just other books of subsidiary or original entry, the cash book also falls into both parties or both sides. Now, the question might come and they ask you, for example, in the objectives, they ask you which book is a principal book and also qualifies to be a subsidiary book. Your answer should be the cash book, because it's the only book of accounting that is a principal book and also the subsidiary book. Now, allow me to look at a ledger. So, when we talk about a ledger, we saw an example of a ledger. We said a ledger looks like this. So we have our debit side and our credit side. So when we are receiving goods or we are receiving anything of cash or we are receiving any item, we debit it. When we are losing any item, we credit it. So this is our ledger. Now, the ledger is divided into 2. We have the personal ledger and we have the impersonal ledger. So when it comes to the personal ledger, we have actually other 2 examples that fall under the personal ledger. And here we have the sales ledger, and also we have the purchases ledger. So these are the 2 ledgers that follow under the personal ledger. Then here we have the impersonal ledger, we have the general ledger, we also have the private ledger. Now, let me talk about the sales ledger. The sales ledger, it's a ledger that records debtors. Remember, we are selling goods on credit. Now, when we sell goods on credit, we shall record the names of those people under the sales ledger. So, sometimes it's called the debtors ledger. Then, the purchases ledger. This is where actually we get goods on credit. So, it's also called the creditors ledger. So, the creditors, they are found in the purchases ledger. So, the sales ledger, it records the debtors' transactions. Then the purchases ledger records the creditors' transactions. Now, when we get to the private ledger, the private ledger is like the owner's ledger. Very many times, this is not revealed to very many people. For example, it has things like capital. In an organization, not everyone knows the capital the owner puts into the business. So it's known by a few people in the organization. Then we have things like the drawings. For example, the owner might come and pick some money from the business. So it's all about the owner and maybe the accountant. Then we have things like profit or loss. So these are the things that are found in the private ledger. Sometimes it's known as the owner's ledger. Now, every other thing that's not found within the personal ledger, where we have the sales ledger and purchases ledger, and the private ledger, will fall under the general ledger. So, we have things like sales. For example, if we make sales now, this time we are selling on cash basis. So you have sales, purchases, those ones can be found in the general ledger. Whereas the sales ledger records debtors what? Debtors transactions. Actually, the difference is here. We can have the sales account and the sales ledger. Now, the sales account records the transactions of the sales on cash. Then the sales ledger, it records the debtors. It records sales but to the debtors on credit. That's the difference here. Then, lastly, I would like to talk about the cash book. Now, we say that the cash book is a principal book as well as a subsidiary book. But then it records only transactions of cash. So we look at the receipts and payment, like we shall see in our videos. Then the cash book has close to 3 examples. We have the single column cash book. We have the 2 column cash book. We have the 3 column cash book. And then we also have one that's not usually, of course it works with the organizations that really have a lot of funding, and sometimes when they want to release some money for maybe office expenses. So that's called the petty cash book. We shall look at a video on its own on this, the petty cash book. So basically, the single column cash book here, the differences between all this is in the amount section. Of course, here, the amount section is 1. When it gets to the 2 column cash book, remember, we are transacting, and if it's cash, someone might owe to pay by check or by cash. So here, when it comes to the 2 column, we shall differentiate, we shall say cash or bank. So that means we shall have the 2 columns of cash and bank. So that means we are dividing this into 2 to become cash and bank. So remember here, single column, whether they're paying by cash or by check, we shall record the same amount of money under the amount section. Whether bank or cash, we shall record it here. When it comes to a 2 column cash book, we shall divide the amount column and we divide it into 2, into cash and bank. So meaning, when money comes as cash, we shall record it under the cash column. When it comes by check, we shall record it under the bank column. Then when we get to the 3 column cash book, we shall look at the discount allowed and discount received. For example, For example, if we are having debtors and we give them a certain percentage, maybe a discount that, for example, is 10,000, and we give them a discount of 10%. So that means they won't be able to pay 10,000. They will pay 9,000 minus the 1,000, which is a what? A discount. That means we are going to include it under the amount section. We shall have discount allowed, cash, and bank. Then we shall record the discount allowed and also the other remaining amount of money where it's supposed to be. That's it. That's just an introduction to our accounting books. We shall solve numbers on each of these, and also on the cash book. So thank you so much for watching. This is Kevin Davis Accounting. Subscribe, like, and share to your friends.